Hello and welcome to this first lecture of this new module on financial asset classes differences in this course on practical approach to investing personal finances. So in this module, what we're going to do is to give you some in-depth understanding of what are the differences between various financial asset classes that we talked about at length in the last module, so that you can help decide where to invest your hard-earned money and maximize your returns. In this particular lecture, we're going to talk about first at a very top level, what are the differences between fixed asset classes, gold and commodities, real estates and equity. And in the next, and also in this, we will then talk about what are the specific differences between the fixed income assets like FDs, government bonds, corporate bonds, PPF, and debt funds. In the next lecture, we will talk about the other assets, which are what are the differences between stocks, mutual funds, ULIPs, and venture funds, and then specifically in the various avatars of stocks like cash on delivery, futures, and option. So that's roughly the plan. So what do you think? What are the differences between various asset classes? We have looked at various asset classes. So what do you think are the differences between those asset classes? Any thoughts? So specifically, let's look at what are the differences between fixed income assets, gold and commodities, and real estate and equities. And in terms of liquidity, what is the ticket size of investment? How much time does it take to do the transaction? What kind of returns do you expect? What is the capital growth prospects? What are the risks specifically involved? And how can you invest? What are the investment vehicles? So any thoughts on each of these? I know it's a tough and loaded question, but anyway, whatever you can think should help tally when I'm going to the next slide. So if you look at each of these parameters and among these four categories of broad categories of financial assets, you see fixed income assets is very liquid. You could have if investment in liquid uh, debt funds where you could easily sell it the next day, or you could go and invest in fixed deposits for many years, 5 years, 15 government bond for 15 years. So you have wide variety of choice in terms of liquidity. Gold and commodity again are reasonably liquid. Commodities are liquid, it can be bought and sold, but again it depends on the pricing. And gold has particularly one issue in terms of its purity. So if you can compromise on the rate and the purity, you could sell gold quickly. Real estate is not very liquid. It takes a while. I mean, it is the sales realization and ability to sell depends on specific property, and it takes quite some time, and it's not easy to sell that. Whereas equity is again very liquid. If you look at the size of ticket size, fixed income assets can be very low to you can go as high as you want. So is gold and commodity. Real estate has a minimum ticket size of a I would say tens of millions of rupees at least to be able to buy and sell the real estate. And equity again has a very small to can be very high. The time taken to transact can be low, specifically in fixed income assets, which is sold very quickly. Gold takes a bit of time. Real estate takes long time to sell because it's not very liquid. And equity again has a very low transaction time. Uh, Among the category, the fixed income assets have the lowest potential returns, but they provide regular income. The gold and commodity has returns even lower income than the fixed income, but they're particularly useful in the times of the financial turmoil. The real estate is a growth investment because the price of houses and other property can rise substantially over a medium to long term period. Equity also receives if you investment in equity apart from capital appreciation, you can also receive income from the stocks that you hold, roughly about 4% in India. In terms of capital growth, there is no opportunity for fixed income growth because the return is pretty much tied up to inflation. So the real capital growth doesn't happen. Gold also doesn't have opportunity good time because in good times the prices of gold drop. It's only in financial turmoil times that you can have a capital appreciation. and real estate has a good potential too for capital appreciation. So has equity. Can also have value of original investment over a medium to long term period. 3 to 5 years is the time that you should look at for any capital growth in equity. What is the kind of risk that you need to take? Fixed income assets have practically very little risk, and especially if you are investing in government bonds, you are risk free. Your money is guaranteed by the government sovereign of the country. Gold has particularly the risk of theft and adulteration. I mean, if you give it and you want to take it back, it could be adulterated. You could easily lose it. The real estate also has a risk of fall in value and carries risk of losses. Equity is the riskiest type of investment. Prices can be volatile from day to day, and shares are generally best suited for long term investors who are comfortable withstanding these ups and downs. What are the investment vehicles that you have? And we saw that earlier. It's a quick recap. In fixed income assets, you could have high interest savings rate, fixed deposits, bonds, corporate and government bonds, provident funds, and debt funds. In gold and commodity, you can invest in physical bonds, ETFs, etc., etc. Real estate, you could do again physical, which is most of the cases. A real estate investment trust is picking up. A real estate investment trust fund is picking up, REITs. And equity, you could invest in terms of shares, mutual funds, and options, and also in some categories of mutual funds in case of equity. Let's now dig deep into the differences between the fixed deposit, government bonds, corporate bonds, PPF, and debt funds. And again, we would look at five parameters: liquidity, ticket size, tenure, returns, and risk. So, any thoughts on this? The fixed deposits are issued by the banks, and whereas the government bonds are issued by your central bank, Reserve Bank of India. Corporate bonds are issued by the private companies to rate the funding needs, and PPF is issued by what is called PPF Commissioner, a separate constitutional body. And debt funds are issued by the mutual fund. So there are different people, different financial institutions who issue these. Uh, Liquidity, the fixed deposits has low liquidity as the funds are locked on a term chosen. So whatever term you choose, whether it is 3 months or 15 years, you are locked in for that. And if you want to have a premature withdrawal, then you have to pay a penalty or a term extra money for doing that. Government bonds are fully locked; they cannot be traded, as well as you cannot be get out of the investments. Corporate bonds again has high liquidity as they can be traded. PPF again has low; your money is locked in for 15 years, and debt funds again has high liquidity. Ticket size as not particularly in India. I'm talking about the fixed deposits are 5,000 rupees onwards. Government bonds can be 1,000 rupees. Corporate bonds also 1,000. PPF can be 500 rupees per annum. And debt funds you can invest as low as 100 rupees. The tenure varies again. Fixed deposits, as we were talking about, varies from 35 days to 5 years. Government bonds from 5 to 30 years. Corporate bonds from 1 to 25 years. PPF definitely 15 years. And debt funds you could do in 1 day and 1 year. The fixed deposits are the safest. Government bonds are the safest actually, and then you follow by the fixed deposits. The government bonds are safest because they are guaranteed by the government of the country. Fixed deposits are not guaranteed by the government of the country, but and in case of default of the bank in the economic system, your money is at risk. Corporate bonds have a credit risk as well as market risk and interest risk because your money can get lost if the place where the bond is invested it goes bust. PPF again is very safe because it's for the retirement funds, and debt funds carry interest rates and credit and market risk. So these are the variety of features that you see of these fixed income assets. What do we do in the next module? So in the next module, we will take a look at differences in stock, mutual fund, unit-linked insurance plans, and venture funds. So thank you so much for watching this first lecture in this module on financial asset class differences. I hope you've learned again something new and you're enjoying, and I do look forward to see you again in the next lecture.